Joel, let's do chronologically Twitter because it comes up first. What are you expecting with this report?
Yeah, good morning. I mean, Twitter definitely it's been under pressure. You know, Snap's reaction yesterday led to kind of some selling pressure on Twitter as well. So it seems to be kind of a little bit of a coin toss here with Twitter. Here we are. They're going through some health initiatives to clean up the platform. That's ongoing. The biggest concern I've heard from investors into this print is just continued potential ad budget dislocations as they're phasing out some of their more ad legacy products. I think Dorsey's done a tremendous job in focusing on cleaning up the content, trying to remove some of the toxicity to some degree as best as he could. But that seems to be the key, potential ad budget dislocations and kind of what we're going to see as far as monetizable daily active users, which you just mentioned. You know, the street's expecting about a $142 million number versus 139 million, sequentially. So I think any upside to that 142 is what the stock needs to kind of work in the near term. Otherwise, you could see the stock drift down to about 35 before you see money step back in.
All right, so Twitter and social media in general have a big 2020 coming up. You've got elections in the United States. You've got the Olympics. All of that should be good macro-wise for Twitter and other social media companies, right?
Oh, 100%. And that's why I said if you do get a sell the news type of reaction on Twitter, or there are signs of kind of hiccups as far as advertising goes due to some of their phase out of the legacy products, which is ongoing. I think you're right, 2020 election, the Olympics in Japan, it really sets up for a pretty solid fundamental outlook heading into 2020. And I think it's a platform where people still are being attracted to. And again, I think the health initiatives of Dorsey and company is going to help kind of translate to better retention rates and just improving engagement trends for the user base, which will kind of continue to attract advertising dollars.
All right, Joel, we got Amazon after the closing bell today. Microsoft reported strong growth in its cloud business, Azure, but it didn't move the needle for the stock that much. What does Amazon need besides AWS to do well?
Well, that's the key right there. So everyone knows, the focus is still on AWS. Most guys I talked to are expecting anywhere from 37 to 38% year-over-year growth. It'd be fantastic if we saw 40% plus. I think that would obviously trigger some incremental buying. But other than that, Amazon stock has underperformed in 2019, and they've told us for a while 2019 is going to be a year in investments, whether it's towards their cloud platform or one-day shipping. This is kind of what's been plaguing Amazon in 2019. We've seen it before with other large cap, growth companies. Anytime you see, the word investment kind of ratchet up or capex, go higher, growth investors kind of cringe a little bit. And another thing with Amazon as well, no doubt regulatory antitrust overhang concerns are real. We've seen mutual funds have been trimming, really out of FANG since start of Q3 of this year. Netflix is in its own little world, but to me, that's the key. Okay. What they say really on the regulatory front and kind of Amazon Web Services, and then 2020 from an investment point of view.
All right, Joel Kulina over at Wedbush. We didn't even get to talk about the expos.